Good afternoon. My name is John Gallo, and I'm a principal at UHY. And I'd like to welcome you to the UHY Construction Update 2021. 2020 has been an unprecedented year, and it seems like on a weekly, almost daily basis, something's changing. Just this week in Michigan, our governor put out a 3-week pause on businesses in an attempt to slow down the spread of COVID-19. It has been peaking in our state in recent weeks. So who's going to follow this order, and how does that affect businesses again that have just gotten back from being shut down? That being said, we have to continue to move forward. Like the Marines say, improvise, adapt, overcome, and I'm sure we will all do that. Can I get a hoorah? I love that from the Marines. All right, enough of my motivational speech. Today, we have two great speakers that come from separate but equally important financial sectors, the banking and surety. First, I'd like to go over a couple administrative items with you. Our presentation today will be 60 minutes, and we're going to try really, really hard to hit that 60-minute mark. I know your time is very valuable, and we really appreciate you joining us today. Our presentation will go somewhere between 30 and 45 minutes, which will leave 30 to 15 minutes for questions and answers. After the webinar is concluded, each of the recording of this webinar will be posted on our website and any kind of handouts that we have for you. Post-session, you'll get an email with a survey, and please provide feedback. We really take that to heart, and it really helps us to make the best presentation possible for you. If you mark down that you need CPE credit, this qualifies for 1 hour of specialized knowledge. A couple other items. Everybody's in mute mode, and we'll be answering questions at the end of the presentation. So if you do have a question and it pops up in your mind as the presentation's going on, please type that question in the question comment box on the side panel, and then we'll be monitoring those as the presentation goes along. And one way or the other, we're gonna answer all questions. So we'll either have time in the session, or we'll respond to you after the fact with an email back to you answering your specific question. So today our presenters are Bob Bridgman and Fran McGrath. Both are senior VPs. Bob's from Bank of America, and Fran is from Liberty Mutual Insurance. So I always say, who knows you better than yourself? So I'm going to let Bob and Fran give some background information on themselves. So guys, take it away.
Thanks, John. Appreciate it, and good afternoon, everyone. Appreciate being here with you. You're seeing my basement of my humble abode. So if anything happens upstairs, it's because of construction work going on. By way of background, my name is Bob Bridgman. I work for Bank of America, and I've been with the bank 17 plus years, 15 of those years in the construction and engineering industry. My team is responsible for companies that are top line in revenue of 500 million and greater, and both public and private. We offer all banking services such as credit, treasury management, investment banking, risk management, and wealth management. Lastly, I would like to thank UHY for having myself and Fran McGrath speak to you today. Fran and I have a lot in common, but as we were getting to know each other more so for this presentation, two things that came out was Fran likes to be called Fran and not Francis, and I like to be called Bob and not Robert. Both of our mothers would call us Francis or Robert when we were in trouble. So hopefully at the end of this, when questions are being asked, you don't respond by Francis or Robert, and more by Fran and Bob, so we know that you enjoyed the presentation. With that, I'm going to turn it over to Fran. He will introduce himself and then also provide to you a agenda of what we will be discussing today. Fran?
Thanks, Bob. I appreciate the invite from our host today, UHY. I'm real happy to share the podium basic with you. We have collaborated well and gotten to know each other. I feel like I've known you now a long time. From my background, I've been with Liberty Mutual Surety for almost 25 years. It will be in the spring. Prior to that, I'm a CPA by trade. I was in the public accounting mode for 12 years. And during that time, mostly in the construction arena and doing some litigation support work. During my tenure with Liberty Mutual Surety, I've been, started on the claim side, was the CFO for a period of time, or chief underwriting officer, chief operating officer. I've mastered none, so I'm now in the chief credit officer. So I had a lot of different experiences, and I've been very fortunate on the journey here. So Liberty Mutual Surety provides surety contractors across the U.S., all 50 states, and even now extensively across an international spectrum, a wide array of services abroad, from the smallest to the largest, and everyone in between. So today we hope to get into some of the details and impacts of that you may think are going on currently and what the future looks like. And so let me just get into what we'll cover today. Bob and I will both give a general background of what we're doing as in our capacities, lending, what's the capacity from the surety. We'll talk about appetites, underwriting approaches. We'll assess conditions in the U.S. economy. We'll get further into assessing what the U.S. construction market has and what's going on, what some of the predictors and uncertainties are. We'll talk about the political impacts of the construction economy and some of the stimulus packages that are being discussed and the uncertainty of when, where that may happen. And we'll hit the home stretch talking about some connections to the recession in 2008 and what the spring recession was, where the real dip in our economy occurred. What are the similarities and what are some of the things that may be shaping up in the future? We'll cover lastly what the best customers are doing right out there, what we're seeing in best practices, and other miscellaneous topics as time permits. So that's the agenda. And again, as Bob said, if you remember to call us by our first name, I know we've made a good connection out here. So Bob, why don't you start in the background, just talk about Bank of America and the lending capacity and appetites out there.
Sure, thanks, Fran. Boy, 2020 started off, let me back up a little bit. 2019 ended the year extremely strong. As we were going through planning sessions for 2020, was really optimistic, was more concerned about execution of projects and really risk assessment going forward. And the first quarter of the year 2020, it was going strongly. Construction activity was at an all-time high. Results were coming in favorably. Unemployment was extremely low at that time, Fran, as it is today. And really, like I said, was more concerned about execution on projects than I was anything else. And then all of a sudden, COVID hit, which kind of changed some things. But one thing that I would have to say about the industry, and I commend everybody on this call, is that the industry was deemed essential. And so, unlike my counterparts in, let's just say, oil and gas or hospitality or entertainment, we have continued on and done fairly well. And so because of that, this has been for myself and my team and for Bank of America an unbelievable year for the construction engineering side. Now we'll get into some softness that we're seeing, some concerns that we had, but overall, as we went from 2019 into 2020, it was really, a nice element going forward. Fran, what would you see from the surety side?
Similarly to what you're describing for Bank of America and the banking industry, the surety industry's had some robust years coming off of the last downturn. There's cycles in the surety. Every 10 years, there seems to be a wave of loss that happens and impacts in the severity and a frequency aspect once every 10 years, as I said. So we've been coming in a very robust time, and construction in general has been well. So surety has done well. Surety bonds are issued in the public sector and generally by law, and we do private bonding. So it's been very good. The loss activity has been very favorable for the most part, for isolated issues out there. So it is with that we were entering the 19 year with most of our contractors having robust backlogs, good profit in the backlog, and good outlooks with pursuits. So we were expecting a very, very robust year in 20, and it still will be with some exceptions. However, when the pandemic kicked into high gear in the earlier part of the year, life as we knew it changed. Obviously the work from home issue is one thing, but contractors were in a position that they never seen before. So it is, we'll get into some of those details, but nonetheless, it's an interesting time, and we'll get through it. We'll go through some of these insights. But from an appetite aspect out there, the types of contractors that we're looking at and have in our portfolio, if you took a third type approach, it would probably be in this. We would have a general contractor population of probably more than a third, about 35-37%, heavy civil road, and about a third, and then the remainder in our subcontractors and specialty contractors. I mean, there's plenty of capacity to support construction contractors out there in the surety industry right now, even with the uncertainty, because backlogs are good, and the pressures that we all see and the headwinds coming on haven't really materialized into financial distress and the loss activity. Why don't we get into some high-level underwriting approaches, what you're seeing on the lending side, Bob, and what some of the things you're looking at out there?
Yeah, from the lending side and from the credit criteria, obviously, I work for a bank, and we all want the top, low leverage, excellent cash flow, a lot of liquidity, and then, thank you very much. Here's some money. Like a client told me, you provide me an umbrella for a sunny day, and then when it's raining out, you ask for the umbrella back. And I started laughing. So I get that. But no, I mean, really, over the years, when I first got into this industry, by way of background, I came from the equipment finance group within Bank of America and was asked to take over construction engineering 15 years ago. And when I did that, I didn't really know what I was getting myself into. And so doing some research, I realized back then there was 5-7 year cycles that you could almost, follow to a T and could underwrite almost to that point in time. That has changed. The cycle has elongated because of the project complexity and the length of the projects. But more importantly, from a cash flow and leverage side, that's always remained our bread and butter. Don't like a lot of leverage, certainly like a lot of cash on the balance sheet, a lot of positive liquidity. But as I have grown and the team has grown, one of the things, Fran, that I've noticed, it's been more of a three-legged stool. And those three legs are, can the client operate? Do they have a solid management team? And if they have those two, then the third, which will be financials, will follow right along with it. And so, over the years, we tend to gravitate more to the first two legs, knowing that the third leg will come along. I mean, this obviously is an industry where it's a roller coaster. It's not a merry-go-round. So when I look at it, we tend to look at client selectivity as a very, important position within our positioning ourselves within the bank. But when it comes to the operation and the management team, we put a lot of emphasis on that as well. Fran?
We have a lot of similarities and overlaps, Bob, in the approaches. I mean, if you looked at the C words, the capital or cash, the capacity to execute, and the character, they're the fundamental legs that the surety relies upon. And we do get into, financial assessment, the operational assessment, and we do some predictive analytics and modeling, in a credit world that we live in. But our focus too is really listening to the story, right? There's a lot of different profiles, and contractors are very adept at managing their businesses and watching their tax. So you have to understand the strategies with regard to, sorry for that, if I don't hit re-authenticate, I'll get cut off here. So sorry about that. Safety features here. So in looking at the different characteristics in there, we focus on the leverage, but we listen to the story where I left off of what the needs are, come up with a solution. We're evaluating similar things. What's the liquidity, right? Are they, depending on what type of contractor, they may have debt for equipment and other things. Do they have lending capacity, right? Are they a good client? What's their reputation in the marketplace? But in this current environment, it's definitely liquidity and cash is king is really a safe harbor to have as we go through an uncertain period here.
Especially with France. I was going to, sorry, I didn't mean to interrupt you. I was going to also add, when COVID hit, it kind of reminded me of the recession of 07, 08, and really where we're focused a lot on right now is backlog and book to burn and execution issues. I mean, those, the leverage and the cash flow, we can see that, but the more short-term measures is what we're looking at from the lending side as well.
I'd agree. Coming into 20, backlogs were good. Profit margin in the backlog was good. Subcontractors had probably more robust profit in the backlog in general. And it makes sense in that high demand position in the market, right? Lower supply, they're getting better price. And when the times are good, they have to get it so that they can survive when the times are leaner. So not unexpectedly here. From a recent survey that I read from the Associated Builders and Contractors out there, that more than 3/4 of contractors expect margins to be flat or worse over the next 6 months. So kind of consistent with the economy. It was recovering, but the recovery has been slowing with other uncertainties. COVID-19, election fatigue, and what's going to happen there. And after inauguration in January, what are the policies that are going to go forward? Some of the uncertainty there. Other factors in the uncertainty going forward, we'll get more into this as we discussed in prep, the bidding opportunities, the increased competition, what are material prices? Are we going to be subject to tightening standards, or are we just going to look at things different? What are the shortfalls in funding in state and local governments and things like that? So there's things that we'll get into more as we assess the economy and the work available out there. Any other comments in that regard, Bob? On that?
No, I think that's kind of hopefully will provide everyone with a framework of what I look for on the lending side, what you look for on the surety side. I always say that you are always looking out the front window because you know of projects coming up long before I do. And we're kind of looking out the rear window a lot of times after results already are posted and come in. So I always love hearing what your comments are and what you're seeing in the marketplace as well. So let me ask you, Fran, what's your thoughts on the conditions of the economy and then break it down into the construction market specifically, right? I'd love to hear what you have to say on that.
Sure. I've been using this and updating these points as I'm going to go through here. Let's just start in general as we get to the U.S. economy and the conditions. we've all had some fatigue, right? I like to start with the positives and the silver linings that are out there, because we're in a chaos period of time. 24-hour newscast. The first 15 minutes of every newscast has been social discord, pandemic, election fatigue, as I said, fires, hurricanes, and up until some announcements with COVID vaccines, the stock market volatility. Even today, it was down. So it's been like an old Bill Murray, old Groundhog Day movie, as the repetitiveness of the news. So in the midst of that uncertainty, there are positives. Pfizer and Moderna have come out with 90% test in their trials about effective vaccine advancement. Others aren't far behind. This will have a major impact on the positivity of the economy in a lot of ways. Despite the political uncertainty and tug of war, stimulus is going to be needed. And you and I will talk about some of the factors that are driving that. All parties know that it's needed here, that the unemployment rate is still above where we started. But we're not going to see a stimulus bill in the economy till, I believe, till after inauguration, and it'll take some negotiating there. So everybody knows that we need infrastructure. Infrastructure and home building are two positive factors assessed in an expanding economy. So I think they're going to focus on those needs. But it's, there's that push-pull of what will happen and when, how long the backlog is going to last, what's the status of new work, will the funding be there for new work, and what are the impacts of COVID as it relates to, as there were shutdowns, we haven't seen of work. Most of it was deemed essential, and about 85% across was ongoing. Where I live in Pennsylvania, and in the Northeast was the hardest hit, where there were shutdowns and work impacts, stoppages. That will play out a little bit in the year-end financials, but the prosecution of the existing work, right? Is it going to be efficient? Social distancing, even on the job site, safety protocols. Can you prosecute the work as timely, right? So, there are other positive things that I think that we could talk about collectively here. I'll pass some of that to you. The market is up. That's not reflective of the economy. It's more about sentiment. Jobs have been restored. Construction spend is still healthy, but how long will that last? So let me throw some opportunity to you, Bob, with regard just a high-level view on some of the things you're seeing out there.
No, I think you said it well, and I'm not obviously an economist, but there's all kinds of reports and data that you can pull every which way and dissect it any which way you want, so you can come up with your own conclusions. I would just say, from a lending perspective and from a banking perspective, and for the audience on this call, rates have been low. That's been positive for you. I mean, like, if you need money, now's the time to borrow. The question is, can you borrow, and from who? And then if you're a net depositor, rates are really low. You're not getting anything for your money. So it's kind of like a yin and the yang type of approach. And so as we, on the lending side and the banking side, look at this dilemma, Bank of America, as well as all banks, are flush with deposits right now, which is, causing a little bit of trepidation as far as we need to get that out the door, and how do we get that out the door? And so those have been all internal discussions that we've been having, about the economy and where it's headed, because quite frankly, by all indications, it doesn't appear that the Fed's going to raise rates anytime soon. And it'd probably be more at the end of 2022, maybe 2023, with one or two increases at that point in time. So I look at it, where are we going to, and how are we going to survive in today's world for the next 18, 24 months? And that kind of, gets me back into, a lot of this has the same feel as the recession in 07, 08, where, construction engineering has been a resilient industry and has been able to move forward. I don't think it will be any sort of hockey stick of approach, but it will be a gradual increase moving on out. And There are certain segments that are extremely hot right now within the construction space. And then there's certain, segments that have fallen off or are just staying level. So it'll be interesting to see. Everyone's been talking about the infrastructure bill, Fran, and like what Biden and Harris are going to be doing in the new administration. But as I was researching that, it's interesting that whoever, Republican or Democrat, comes into the White House, historically, that does not really change the market overall one way or the other dramatically. So the new president typically has the opportunity to pass one or two bills. Will infrastructure be one or not? I think we've been waiting for that for so long, hard to say. But I don't know if that's really going to be the driving force. And if you're in the C&E space right now and you're looking for that to be like your holy grail, I don't know if that's the right avenue to pursue at that point in time. I am really cautious in looking at the states and the lack of receipts that are coming on in and how that's going to impact our industry overall. Thoughts, Fran?
It's a very good segue into a very fertile area when you look at the different cycles out there. In 2008, right, I'll say from a surety aspect, we're kind of a lagging industry. Things that happen today may have an effect 18 to 24 months. And in fact, as I look back on loss activity that we had, usually the development is 30 months after the inception of the project when we've had that. So when you look back at 2008, again, very similar to what we've seen in coming into 2020, a very robust construction environment, good profits, good margins out there. Then the dynamics, and at that time, that was a financial sector collapse, unlike currently, which is a pandemic across many sectors. In tax revenue, receipt revenue generation is a pandemic across a lot of areas in our economy. So state, local, federal government, right, and financing the shortfalls with debt, right. So there's some of the things that are common. But the other part, back to 2008, as work was starting to become less, the profit margins were dropping. People didn't assess their overhead timely, and they were taking work that was too cheap, right? And that played out. So and that was about 3 years after the 2008 financial issue. So similarly, you have the worst period potentially still yet to come. And as I look out, and we're all in the midst of financial planning and getting ready for what we think 21 and even out and then 3-year planning, what it may be. It is so uncertain how you're going to do that because there's so many dynamics changing. But the one thing that we've seen common in these recession or difficult times is that material prices rise right before a recession.
Yeah.
And then as they strengthen, the recession, that is, material prices decline, but albeit spending and backlogs dropped, margins dropped, increased competition, taking that work cheap, like I said, relative to your overhead structure, losses follow. And that's how really it's eerily lining up in the current period potentially. And what will change that? Well, stimulus potentially, vaccine, the confidence, things out there are in need of happening, and it could change the length or the uncertainty. But again, getting back to the backlog issue, how long will backlog carry you if the recovery goes longer than anticipated? How long can your backlog and last? And remember, the last recession in 2008 lasted 16 months, but it took 51 months for GDP to recover. And so public spend has been at a very low threshold with a few upticks. Private spend has been driving the total construction spend out there. So your points about lending and other things, are really good. It's just that what's the consumer confidence to do the investment and go, go forward with projects. There are some of the uncertainties that we're out there with. How about your thoughts to any of that?
Yeah, I completely agree with you on all those points. I mean, it's eerily resemblance of the last recession. I keep bringing that up, but it's the one point that you kind of, experience comes from past. And so we're seeing the same thing. And from a backlog perspective, from a commodity perspective, from a pricing perspective, from a risk assessment perspective, what did we learn from the last recession was some clients went into sectors that they historically had never been in before because they saw higher margins than what they were used to obtaining in their bread and butter, only to get their hands just slapped and some of them chopped off by going into that sector instead of staying with their bread and butter and kind of like doing that. In the same regards, you need to grow, right? And so how does growth come? How does valuation creation come off of growth? You have the growth and then you have the margin aspect of it, but just to grow to take your company on the ENR report from 20 to 18, that's really not the growth that I'm looking for as a banker or as a lender. What I'm looking for is how can you provide better service to your clients in a turnkey type of environment, and knowing that you can add additional margin dollars to your profitability because you've entered into another sector. The one thing that I did notice, and I'd be curious to hear your thoughts too on this, Fran, is with unemployment being as low as it was, and the projects becoming so complex, and there were so many of them out there, a lot of the companies did not have enough A teams, what I classify A teams on projects. And so their bread and butter project, which had an A team on it, had to be taken off to go over to another project that they were going into and kind of like put the tape on the dam from the water exploding. And so now both projects are starting to deteriorate. And so, there was that creation of like, oh my gosh, what's going on? You've been a good executor, and now all of a sudden, even the bread and butter projects are starting to lose. So I hope in this time we don't see that same thing to occur. I hope that clients today grow, but know strategically what they want to grow. Does it mean more hiring of individuals? Is it, where do we go from here? Is it technological advances? I think that you have to really analyze both internally and externally where technology is, and are you a participant in it? And I think once we start looking at those metrics going forward, we'll see a little different story than what we saw in the past. Thoughts?
There's a lot of fertile ground in what you're describing there. So a lot of consistency. As we look back and we evaluate lessons learned from prior losses, one additional thing to what you were saying is complexity of larger contractors dipping down into the smaller revenue or project size where their cost structure may not be able to compete. They were trying to keep workers busy until things improved. And so that is a real risk. And so, they've learned, and we have some maturity and ownership out there. The baby boomers are getting ready to move to the retirement aspect. So transitions out there. So I don't think they're willing to give up a decade of profitability for survival. So I think that learning from the past and what happened before, they do, segment their staff between A, B, or C, and know who is going to carry them, and they're going to try to maintain everybody, because talent is still a premium in the industry and will be. More people need to get into construction management. We need more craft workers. Unemployment in the construction arena, even in this uncertainty, has been its highest, and that's been driving improved unemployment rates. But there are still many thousand workers needed to facilitate work out there. So it's an interesting dynamic, but I'm hearing in the continuity and contingency plans out there that things get as bad as what the sentiment is, they will have no choice but to reduce the work staff out there, and unemployment in that aspect will rise potentially out there. So it's a good thing. The profit margins are good, but as new work comes on, if they're not there and there's not funding to simulate other work, competition is going to increase in some aspect, and it's definitely going to, no matter what you do to improve your attraction or retainage of people, economics are going to dictate out there, and it's going to be very tight for a foreseeable future if we don't get certain remedies in the near term. You talked about technology and different things. I think we could talk about those things. I think they're going to be critical. Advancing technology, efficiency, it will aid in the employment rate. We can do more with technology. It's not going to replace people, but it's going to aid and give bandwidth to the existing, so that will help combat the difficulty of attracting people out there. But what else do you have in that regard, Bob?
You made the comment on not replacing people with on the technology side. I agree, and yet I kind of disagree with you there, Fran. And the fact that I think there's so many technological advances. This is an industry, quite frankly, that hasn't been disrupted at all. I mean, when you look at all industries, almost today, every industry has been disrupted by technology in some form or fashion. C&E is the one that really hasn't yet. And yet there's this whole groundswell community of little companies, and I don't mean little, but startup community companies that are attacking our industry. And technology is going to be a major, component going forward. And when I look at it from a lending side, right, one of the things that I look at is, where are you on your internal technology advances, not just IRP processing and things of that nature, but do you have BIM? Do you use AI? IoT, is that a component? So I look at that, and you see different things and companies starting to come up. So I think it will impact employment at some point in time because of the way that it will eventually be designed, be built. Now, I say that, and I understand that, it will be in certain segments and not all segments, right? I don't, at the end of the day, you still have to put a shovel in the ground and dig and do certain things. But I do feel that, as a commercial building, do we still have to do it the same way that we've been doing it for years and years and years? We're already seeing some advances in that form, right? And so you'll see pockets where technology, in my opinion, will become more prevalent than others. If you're a road builder, you're still going to have to, move the dirt and do all that. But there's other areas where it will definitely come into play. And even on the equipment side, the technology is so much further advanced on a go forward basis. So I'm a big believer when I look at companies. Technology is one of the things that I ask my team, when they bring in an opportunity, where are they at? Because to me, that's moving in the future. And that's really what, where do we go from here? As I keep saying, where does the industry go from here?
Mm-hmm. I would agree about the disruption. It is ripe for a disruption time. I I've seen, and maybe we collectively talk about this, where there's been opportunities out there, and I've seen the development. I mean, there's automation machines out there that can do bricklaying, right? And put brick and block in there. You know, what's the cost to bring that technology, and will the market accept that cost, you know, out there with economic uncertainty and tightening potentially out there? There's some of the barriers of entry in that. Not that it's not needed. And if the employment struggles continue, it's going to force the issue. So I think that ripe for disruption aspect becomes more prevalent looking out past maybe 3 years out there in my mind. I've already seen the technology with a client that's investing in these side businesses that fit well into construction, where alternative products, alternative building blocks that can withstand Cat 5 type thing, winds and hurricane, and that doesn't create issues with normal building and rework. It's, you know, the automation and robotics out there assure quality and avoid, with the BIM technology, avoid the complications of what's going on in today's world, or the risk of rework and claims and other issues. So you're right. I think disruption is going to happen. It's just the timing of that.
Fran, what have you, you know, kind of shifting a little bit, what with COVID, you know, what would be your commentary as far as like supply chain? I mean, you know, I've looked at, you know, our clients in our industry reevaluating their supply chain metrics. I mean, when COVID hit, there was, you know, obviously steel and copper, you know, just shot up, and you know, factories are, you know, being shut down for a little bit and so on and so forth. And yet building products has, you know, specifically home building, you know, do-it-yourself type projects has just rocketed on up. So lumber and things of that nature. What are you seeing from your clients as far as their supply chain?
Well, this pandemic is a global pandemic, not just US. And as you know, with different trade agreements like NAFTA and things, we weren't producing necessarily all the materials and goods for construction in America. We were dependent on foreign imports, glass, like, you know, curtain wall, steel. Just look at the N95 masks, where they were, you know, and things of that nature. We were a global economy, and manufacturing will be a hot spot going forward. This just-in-time inventory of materials, it will be no longer. We will need to, and because of the pandemic, everybody's been competing for a lot of these goods. And when everything shut down, getting goods, foreign goods into that you were dependent on bid the job became the issue. So it's that aspect of construction going forward is going to change. You talked about the lumber, right, aspect. I'm just go back to that just a minute here. In anticipation of home building and that aspect drying up or slowing down, US and Canada producers cut way back. So supplies were they didn't want to get caught with high inventories, so they cut back. And what happened? Home building and second resale of homes is skyrocketing and back on. And the supply of a 2x4 diminished. And then if you go, you're doing your do-it-yourself home project, that 2x4 is multiple times. I think the price has gone up 20+%.
Yeah.
In the recent times. And so I think we have to look at things differently in our supplies, but you know, we're depending on many things coming from different aspects of the world, and it's going to have an impact. And I think, you know, as we have a change of regime, there's going to be incentive to produce internally, get our economy back, and manufacturing aspect will be one of those things, which will create opportunities on construction projects, but it's going to take a while as well. So that part is important, but it's not going to change overnight. How about your thoughts on that?
Yeah, I mean, in the essence of time here, Fran, I you know, if I can just kind of skittle this a little bit, where do we go from here? what are you seeing with your clients' best practices? I can kind of share what I'm seeing from our clients' best practices. Fortunately, this time in this, I guess it's a recession. The banks did not start it, so there's plenty of capital out there. It's a good borrowing environment. Pre-COVID, it was a good borrowing environment. COVID hit, banks retracted, made focus that our clients were taken care of first and foremost. That's where client selectivity was like a key component for us. And it also, I will say this, the one thing that I learned in COVID was clients that I have been working with for 15 plus years became friends. And for me, that's a major like positive that came out of this, because for me, I tend to want to have my business associates and my personal relationships, and very seldom do they interact. But COVID has allowed me to cross that line with some senior leaders, and it's been very, very informative and rewarding for me. And so as we got to know the clients, they got to know us, and as we're coming out of this and will come out of this, I think it makes the relationship stronger. And so where I go with this at the end is that for all that are out there listening right now to Fran and I, if you don't want to talk to banks or bankers or sureties and all, and there's plenty of us out there, I get it, but at least have a stable of relationships that you have, so that you're not putting your eggs all in one basket, because you just never know how that's going to work out. And so that's one of the best practices that I've seen, quite frankly, for me personally. And then I'll get into like the lending, and Fran, if you'd like to add on anything. Or
Yeah, I think you're absolutely right. Among many things, peer groups, knowledge transfer, right? Communication, learning from others, expands your horizon out there, and helps you and helps them from different perspectives. But what are customers doing right? I mean, talent management, there's a lot of continuity discussions going on. So people are driving ownership changes to attract, develop, retain, invest in their people. Diversification strategies, not necessarily if you're paving roads to go to do bridge painting, but having different type clients in different segments, and making sure you have the wherewithal to do those things. Start out small and get big. Strategic alignments with joint venture partners, sharing of risk. We hit technology, BIM, timely reporting, estimating tools, value engineering, anything that's going to help robotics, analytics to deliver goods quality and maximize profitability is going to be really important to compete in the go forward world, whatever that will be.
yeah, it's been a good run, and one of the good things about being in and covering this industry is that it is resilient and essential. So for that, I am extremely grateful. And good people like yourself and John and others that are viewing today have always made it enjoyable. So Fran, I'll let you wrap it on up, and then we can address any questions that John might have, if that's all right.
I couldn't say it any better. The collaborative knowledge sharing and relationship building, getting to know you and the UHY team, it's definitely expanded my horizon, and I'm appreciative of that too. It's been a good ride. Positive things are going to happen. Positivity is going to be key through this work at home prolonged period that we're all facing and challenging. And my hat's off to the moms out there who work outside the house, inside the house, do all the other things, kids competing with school. My wife's a teacher. It's a different time here. So best to everybody out there. And thank you. John, I'll turn it over to you.
Great. Thanks, guys. Really appreciate it. I do want to get some of these questions in. We have about 10 minutes left. So we do have a handful of questions that I'd like to address.
Sure.
One of the first ones is, what would be, with this new potential presidency, what would be one policy change that would be most detrimental to the industry? And vice versa, what would be one policy change that could be done that would be positive to the industry?
Do you want to go, Fran, or?
Yeah, I'll start with the positive. I always like the good news, all right, and then get to the ugly. I think that coming forward, I do believe infrastructure is going to be a key, but that broad interpretation of infrastructure is schools, waterfront, you know, broadband, a lot of things to get us to move forward. I think that that's going to be a very healthy way to get us moving and get people back to work. I think the issues with COVID, with vaccines coming and therapeutics advancing, is going to help in that recovery period. The uncertainty there's, you know, in everything is, all right, what is the taxation going to be? You know, is it going to drive investment or slow investment? And so I think that has to be carefully assessed, and that could be a negative. Bob?
Yeah, you know, on the positive side, I see the market providing more liquidity out there than what there was in the past. There's dollars there. It's just a matter of how do we spend it and to what, right? So there's opportunities that are present that we need to take advantage of and move forward. On the cautious side, I would say two things. One is the environment and how much restrictions are put in place if Biden and Harris start going back and you know, on the restrictions for the environment. And there's no reason why we can't work together on that. And then lastly, I would just say what would be the political fallout if the world economy, something happened there, which then would take the US economy into a certain light. And so those are the predictive models that, like, when you stress test different things, that we're always like looking to see how does that impact the C&E industry.
Okay. Another question that's come in: with all the hurricanes this year, are you seeing major issues with getting materials, and is there any pricing issues? And how does a company help protect themselves on pricing?
You want to start, Bob, or you want me to
Well,
start?
that's more your line, but I would just say how you protect yourself would be, you know, from a banking perspective, talk to your banker about potential hedging strategy, risk management strategies on commodities, right? And so there's certain elements that can help and facilitate some of that swings on that. The only thing that I will say when it comes to hedging strategy is that if you're going in it to win, you will eventually lose. It's more of a risk management insurance type thing than it is trying to make money off of it. So that's my only commentary on that.
When you look back at the beginning of COVID, and you looked where many of the foreign goods were coming, the countries abroad that were suffering the most, there was plenty of pictures of materials that were intended for our job sites sitting on docks for a prolonged period and coming. I think going back to the manufacturing and producing internally here, we're not going to get there overnight. It's going to take time, but you need to hedge on the material sourcing, right? Have multiple sourcing areas so that doesn't become an issue. Getting into contractual terms and conditions in tight times become more onerous, and risk shifting to the contractor increases. Beware of that in general conditions and other things. Negotiating, having contingencies for uncertainty, that's going to be difficult, but you need to do those things to mitigate risk on the go forward. And the best way is to have some contingency related to those uncertainties. Just look at the lumber, right? Who predicted that? COVID drove it, but they're the types of things that you need to prepare for, and there's not an exact answer going forward.
And John, if I can just add on Fran, because he brings up an excellent point. We're starting to see, and I think Fran, you would agree, in some contracts right now, verbiage where that risk is being sent back to the contractor versus the owner. And so, you know, the contractual language is extremely important on these projects.
It wasn't but a few weeks after it really started that I saw a general conditions provision on a private project where delay and cost increases were not reimbursable. They were on the contractor. So 8.4 of general conditions, right there it was. So people are going to change, but you know, if you're going to do something like that, you better price really high to cover you in that regard. So I think that's a potential hazard going forward here.
Maybe we can get in one more here. We're getting close to the hour. What is the best practice I can do? I assume a contractor. What is the best practice a contractor can do to position their company to look best in front of you? So if you had a 19 financial and they're coming in with their 20 financial, what would you suggest would be a best practice to kind of put themselves in the best light? What, I know you talked about the 3 legs of the stool and the CCC.
You know, go ahead, Bob.
Go ahead.
I want to start now. I'll talk a little bit about some things.
Go ahead, Fran.
Now I look at what I call organizational maturity, right? It's having the talent, right, to do the work. It's having the technology to report on the work. It's having the business plan that shows how I'm going to generate profits and cash flow. And it's all the above at one time. But it's what's your niche? How are you going to attack it? And what are your risk mitigation viewpoints? And you know, what's your continuity to attract and develop and retain the talent, right? It gets back to all those things. What's old is new, what's new is old.
You're saying right there, what's old is old, and what? How did that go again?
What's old is new, and what's new is old. It's many of the same things that we look for, right? It's really the profile hasn't really changed. It's making sure you execute on those things that we talked about.
Well said. I would also add, and it's very basic, this, no matter what we talk about or go through, whatever, it's still a relationship business. And so when it comes down to when my team brings in a new opportunity to me, one of the very first questions I ask is, how well do you know them? And so if it's the first time that they've ever been introduced and now they're coming in with a new opportunity, you really don't know the client or what they're looking for. And so that throws up flags in my head in the fact of, why is this client looking to switch? What you know, there's something else there. Versus if you had a relationship for a period of time and both parties knew each other, now it becomes more of a, all right, how do we get there from pricing, from term, from structure, all the things that kind of go into it, right? And that becomes more of a negotiation perspective. And so that's what I would say, where I said before, you know, reach out to various different bankers, to very different charities, accountants, to get their perspective. So when the time does come, you can kind of, you know, not have just one egg in the basket there, but multiple eggs in different baskets. And I think times like COVID, that's where it really comes into play. It's not when you're doing really well. Then every bank is trying to call on you, and you can push us back. I get that. It's when times are tough, that's when the relationship really comes into play.
I think it's well said. Long-term relationships are strategic relationships, and they will benefit you. Moving around to the lowest cost provider is probably not a good strategic movement in this environment or any environment.
And I'll just leave it at this, John, and I'll be quiet. The other thing that I would just share with the audience is, be honest and transparent with us, because we will help structure things internally to help you succeed. The last thing we do not want to have happen is for you to fail. So when you're honest and transparent with us, we will help. We're not trying to take you under or anything along those lines. But when you're not that way and we uncover it, that's a little bit different story. And that becomes like, okay, now we need to start getting more in depth, like where are you going and how come? So I'll leave it at that.
No, that's great. That's a good point. Needs to be a partnership.
Sure, for sure. Well, we're right at the 2 o'clock hour, so your guys' timing is impeccable. I'd like to thank Fran and Bob for speaking today. You can tell I used their shortened names and not Francis and Robert, so that tells you that they did a great job, I feel. I just want to throw out there that our next session is this Friday at 1 p.m. Eastern Standard Time. It'll be presented by UHY, and we're going to talk about a test, some financial items that are going to affect your balance sheet before you present them to your bank and your surety company, and then the almighty tax piece, which is can really affect you and affect your bottom line. So hopefully, if you haven't signed up yet, please sign up. To do that, you go to uhy-us.com, click on Insights, Events, and then the construction update. So again, thank you, Fran and Bob. You guys did a great job. I hope everybody enjoyed it on the call. I guess I have to officially say thank you. So thanks, everybody.
Thank you. Stay healthy.
Yes, and safe.